There was an IFS survey, that's the Institute for Fiscal Studies, and they found that 80% of defined benefit members didn't know that they could retire early or were even aware of the penalty rules if they did decide to retire early. That's nearly 4 in 5 people misjudging their own retirement benefits. Final salary pensions are often called the ultimate gold-plated retirement plan, but what many believe and understand about their pension can be misleading, incomplete, or just flat out wrong. So in this week's video, I'll describe what a final salary pension is and how it differs massively from a defined contribution pension that we're all a lot more familiar with. I'm going to look at the myths around final salary or defined benefit schemes. I'm going to let you know if they're true or false, if they're fact or fiction. What are the common traps? What are the hidden downsides? And what are the options that are very rarely discussed? So by the end of this video, you'll understand what your benefits really mean and how you can take some smarter action. There's going to be no fluff, no guesswork, just clarity and a little bit of confidence. Hi, my name's Simon and I'm a chartered financial planner. And if you're new to this channel, a very warm welcome. We've got a growing library of more than 80 videos on personal finance and financial education, and they've been watched now by over 1.6 million times. So even though 53% of adults say that they are knowledgeable about pensions, about 35% can only correctly identify what a defined benefit or final salary pension actually is. That means about 2/3 of people are still confused about them, even when it comes to the gold standard of pensions. Now, there's a lot of myths about DB pensions, and we're going to cover many of them here. But if you've got any specific questions, then please get in touch and then leave your question in the comments below. Now, before we get started, a huge thank you to both Gurmail and Lil Blighter, who've asked for this video on DB pensions. Now, DB pensions and final salary pensions might just be the most complicated area of all of financial planning. So please always remember, not all schemes are created equal, and each scheme is going to have their own specific rules. So remember, the scheme rules rule. Now that means you're always going to have to check with your scheme administrator, your HR department, or even your pension office for the details of your specific scheme. Now, a defined benefit pension scheme, which is often called a final salary pension, guarantees a set retirement income, which is based on your salary and your years of service, and it's not based on any investment performance. For example, if your employee uses a formula like a 60th of final salary for every year you've worked there, and you've worked there for 20 years, and you're earning £36,000 a year, you then receive 20 60ths of your salary, or about £12,000 a year, from that scheme in retirement from the scheme retirement age. Now, in contrast, a defined contribution pension depends entirely on your contributions, maybe your employee contributions, and of course, investment growth. And that means you're going to know what it's going to cost you each month, but you don't know what income you're going to get in retirement. So what that means is your income in the future is going to be uncertain. Now, a DC scheme is going to be more portable and more flexible, leaving you in full control. But there's not going to be a guaranteed income. And there's also going to be a range of risks, such as investment risk and longevity risk, as well as inflation risk. And that is going to be firmly on your shoulders. There's also going to be extra fees and charges to pay for. And if you overspend in the early years, there's going to be a real risk of you running out of money during your retirement. Now, the name final salary is confusing, but it doesn't mean that you're going to get your last year's salary as a pension in retirement, although that would be a very good outcome. Instead, DB schemes use accrual rates, and that can be based on your final year's salary. Now, a popular accrual rate is a 60th. So what that means is for every year of service, you get 1/60th of your final salary. So what that means is if you've got 30 years service with your employer and your salary is £50,000 before you retire, then you're going to get 30 60ths, or half of your salary, and that works out to be about £25,000 a year. Well, a final salary pension can offer better rewards if your salary rises more steeply towards the end of your career through promotions. But what happens if you need to work part-time as you get close to retirement due to health issues or family or even caring responsibilities. Well, a care pension, and that's called a career average revalued earnings pension, can build benefits more evenly and more smoothly throughout your career. For example, if you started work 30 years ago on £20,000 a year, you'd get 1/60th of £20,000. In the following year, if you earn £22,000, you'd get 1/60th of £22,000. And then you'd get 1/60th of your income each year throughout your career. And then these tranches are then simply added together over your career and then paid out to you when you retire. So if you're finding value in this video about some of the myths that can swirl around the DB and the final salary pension world, then hit the like button and subscribe to the channel. And don't forget to hit the notification bell as well, so you're not going to miss any of this future content. Now, the Maxwell and the Mirror pension scandal was one of the UK's most infamous pension frauds. In the early 1990s, the media tycoon Robert Maxwell unlawfully took hundreds of millions of pounds from the Mirror Group's pension funds to prop up his failing business empire. After his mysterious death at sea in 1991, it was discovered that about £440 million had been siphoned off, leaving thousands of employees' pensions at risk. Now, this scandal naturally shocked the nation. It exposed major regulatory gaps, and this led to significant reforms in pension protection, including the creation of the Pension Protection Fund, or the PPF. So what that means in today's world is if your employer becomes insolvent and the DB scheme can't meet its pension responsibilities, then the PPF will then step in, and that will then provide some sort of compensation to underpin your pension rights. What that means is if you're at or beyond the normal pension age of the scheme, you'll get 100% of your accrued benefit. But if you're below the normal pension age of the scheme, you're going to receive 90% of your accrued benefits. Now, inflation increases are also going to be capped, and they're going to be paid up to 2.5% a year for the benefits that you've accrued after April 1997. But if you've accrued any benefits before 1997, then this service often doesn't increase at all under the PPF. Now, let's not forget that the PPF continues to play a major role in protecting our retirement futures and currently protects nearly 9 million members across 5,000 pension schemes and manages about £32 billion in pension assets. Well, let me try and explain this in a worked example. Let's say you're entitled to a full pension of £12,000 a year, and you're entitled to a maximum of £60,000 tax-free cash. Now, the scheme is going to apply a reduction factor such as 12-1, but that can change from scheme to scheme. So what that means is you're going to have to give up £1 of income to get £12 of tax-free cash. So if we then divide £60,000 by 12, that gives us £5,000. So that will then give us a tax-free cash amount of £60,000 and a reduced pension or income of £7,000. Now, most DB pension schemes will offer dependent benefits, which is often around 50% of your income, but it can be a lot higher than this as well. So who's a dependent? Well, that again will depend on the scheme rules, but in general, that will include a spouse or civil partner, a financially dependent partner, children under the age of 18 automatically, or under the age of 23 if they're in full-time education, or at any age at all if they're dependent due to disability. Now, as part of any retirement plan, you're going to need to assess what the financial impact would be of losing one state pension on death, as well as 50% of the DB income as well. Well, some schemes will have normal retirement dates of age 60, 65, or it could even be aligned with the state pension age. So it's always best to check with the scheme administrator to be sure. However, you can access your pension early if you need to, and that is currently set at age 55. That's going to be phased in and increased to age 57 from April 2028. So if you do decide you want to access your pension early, there's going to be some early retirement penalties, which are generally going to be applied to both your income as well as your tax-free cash entitlement as well. So for example, if you've got a scheme retirement age of 65 and you want to retire 5 years earlier at age 60, the scheme may apply a 5% reduction in income for every year that you want to retire early. So if you want to retire 5 years early, you're then going to receive 25% less income each year. So clearly, you're going to need to make sure that retiring early is the right option and the right move for you. Now, for most of us who are not lucky enough to have a DB scheme, we need to understand how we can withdraw money from our pensions. So I've linked another 2 videos in this series about what retirement incomes we've all got and another about our tax-free cash options. So thank you for watching to the very end and for your time and for your patience as always, and we'll see you all again next week.